All right, good morning, everybody. Thank you for tuning in to this week's S&P Sector Spider Preview. We're going to take a look at the markets and some of the various sectors and just see what's going on with regards to the supply and demand dynamics. It's been a pretty interesting week. The S&P has been flat, well, almost flat. I think it's broken its uptrend, but there's been some really strange action in the financial sector and material sectors, and we'll see that when we get to it. All right, so just remember our mantra, our philosophy over here. In financial markets, there are price levels that are more significant than others, and more important than others with regards to the amount of supply and demand that exists at them. In financial markets, prices are always doing one of three things. They're either going up, going down, or staying the same. If you understand how to identify and become aware of these trends and levels, it's going to help your trading and your investment process. We don't really use things like Gann theory and harmonic charts, Elliott wave. That stuff is cool, but it's cool in the sense that Bigfoot is cool and UFOs are cool. It's fun to talk about, but I don't think it's credible. So this is just based on common sense and logic. All right, so this is just an overview here. You can print this out off my website if you want to read it. All right, so this is the S&P, the SPY since June. And you can see what I mean here when I say that we've broken this uptrend. See this uptrend line? They're really just a graphical illustration of the, or if used correctly, they should be a graphical illustration of the forces of supply and demand that are going on in the market. So basically what happens when markets are going up, right? When markets are going up, the forces of demand are in control and they overpower the forces of supply. When this trend line breaks, okay, when this trend line breaks, this shows that the forces of supply are starting to overcome the forces of demand, or at least becoming equalized with them. So this, and I've mentioned before that oil prices are up dramatically in the past year, I think about 40% now. The financial sector has not been acting well. People are way too bullish. So we could be seeing some kind of a top here. All right, this is a longer term picture of the SPYs. So if we do head lower, I'm going to be looking for support around the 286 level. All right, now we've been watching this for a while because at the time back here it was an all-time high. So anytime something makes an all-time high and then reverts, that's going to be an important level to watch. So sure enough, when we got here into August, it became a resistance level. And then in September, it was support. All right, the low was on, I don't know, early September. Though we could see here, this was an all-time high. But anyway, so if we head lower, I'm looking for support around 286. Next stop would be this 280 level, which you can see is the top here, the top here, the top here, support throughout here. So I'd be looking for support there on the next stop. Longer term, if we had much lower, this is about 268. This was the low in May and late June and early July, 268. The next stop would be this 260 level down here. All right, so that's the S&P. But I guess the takeaway is that it's broken its uptrend, and so it's either going to head lower or it's going to head sideways in the near future. I don't think we're going to see much upside, but we'll see. All right, so here in the tech sector, you can see over the last probably month or two, we've been consolidating between 73 and 75. Now this is kind of interesting because this is a little ascending triangle pattern, all right, which is usually bullish, or classically they're supposed to be bullish. And this is a type of situation where you can see that there is some validity in the classic chart patterns if you understand what you're looking at. Some people just take these patterns and try to stick them onto a chart somewhere without really understanding what they mean. But what does this mean? Okay, so this is time progressing, okay? This is August. This is September. And as time progresses, what's going on here? Well, the buyers are getting more aggressive. As time goes by, they're willing to pay higher prices. The sellers are content to stay at the same level. All right. So what does that mean? That means the buyers are more aggressive than the sellers. So if we break this 75 level, we're going to could see a decent move up, a couple bucks up. But of course, if you listen to or if you read the real classical literature about this stuff, they say if a triangle trades out to the apex, it loses its validity, and that's kind of what's going on here. But whatever. I'm just trying to point out that if you can understand what these patterns are supposed to illustrate, it's a lot easier to make money off of trading them. You can't just go blindly say that's a triangle, this is a triangle, that's a descending triangle, that's a symmetrical triangle. You have to actually know what they mean, right? In this case, the buyers are becoming more aggressive as time passes. The sellers are staying at the same level. All right, now this is pretty interesting here, and I'll bet you haven't heard the fake news financial media mention that financials have basically been in a free fall since the 18th when the market hit an all-time high because they're too busy talking about trade wars and the Turkish lira and the Supreme Court. But anyway, look at this. So here's an all-time high. Basically, the financials all throughout this period here, all right, the S&P was rallying and the financials did not participate in it. And then you can see over the last couple of months they've been consolidating. Then they gapped up here when the market made an all-time high. And that's got to be some kind of program trade or something where the S&P hit an all-time high and a certain basket somewhere was underweighted financials and they just became a super aggressive buyer. That's my guess. And you can see since then it's been in a free fall, blasted right through this level, the 28-25 level, which has been important. So we are a little bit oversold. But if these things head lower, I'm going to be looking for support around this 2680 level. As you can see, it was support all through here. And even, it got below it here, but only by like 30, 40 cents. So that's the takeaway from here. Financials have been in a free fall since the middle of the month. And when we get to the materials, you're going to see it's a very similar pattern. And I would suspect it's the same thing. Some program somewhere was underweight. And when the market made an all-time high, it had to catch up. This is a chart of the S&P, the financials going back to 2005, and I just wanted to point this out that you can see these things topped out right at 30.50, right before the market fell apart. And in January, they got to the same level, like within a few points of each other, even a few cents of each other, I shouldn't say points. So if these things do rally, which I guess isn't looking likely, but they could, I'm going to be looking for significant resistance around this 30.50 level. You can see healthcare has been on an absolute tear, trending higher, making new highs. If they head lower, I'm going to be looking for support around 92. You can see 92 is an all-time high here. And then it got through it here pretty quickly, but it was resistance. It was support for a few weeks. But they continued to head higher. So if these things consolidate or see some profit taking, look for support around the 92 level. Consumer discretionaries, they continue to consolidate. This is an all-time high here. Bottom of the range is like 115. If that breaks, I'd be looking for support around 110. Okay, because that's where that was resistance here and there was support here. Okay, the industrials, we've been talking about how there's resistance at the 80 level because there was resistance back here at 80. So you can see we got to 80 and sure enough, broke its uptrend. Now we're heading lower. So I'm going to be looking for support if these things continue to sell off around 76.50 because you can see it was a top throughout here. It was a top here, and then it became support. So I would think that if these things head lower, you're going to see support there again. If this level breaks, I'd look for support around 71 because it was well-defined support here, well-defined support here. And it's pretty amazing how these things can come in such close proximity with regards to prices, because there's no way an academic or a fundamental person could ever explain how this could happen. How do the industrials have the exact same valuation here at the beginning of the year as they did last week, despite the fact that interest rates are at different prices or different levels, oil is at different prices? Well, the reason why is because supply and demand dynamics drive the markets in the short term and even in the long term. So don't listen to what the idiots on television are talking about with trade wars. Well, I mean, everyone's going on and on and on about the trade war, but the smart people, the people like Ken Fisher of the world, will tell you, even if Trump gets all these tariffs enacted, you're talking about a 2 or 3% tax on overall trade. So it's basically nothing. And he's not really using them for economic things. He's using them for political things. In other words, I think he's threatening China with trade tariffs so they put pressure on North Korea with the whole nuclear thing. So that's just my take on that. But I don't think this trade war is a big deal. And just logic would dictate, if some companies are going to get hurt by a trade war, other companies are going to benefit from a trade war. Seeing that we have the biggest deficits, I would think that that's going to help us. All right, here's consumer staples, and here's another example of how certain levels are more important than others. Take a look at this 5350 level. Okay, it was the bottom in here. It was the top here in April. It was resistance here for about 2 weeks. And now, since the end of July, it's been the bottom of the range. So you can see we're testing it now. So 5350. So if this thing breaks, I don't really see yet too much clearly defined support till we get down to around 50. And this 50 level is very important. You can see it was the top here throughout May. But take a look at this longer term chart of the staples. All right, here you can see how important this 50 level was. It was basically the top all throughout 2015. It was the low a year ago in September. And then here's the chart we just looked at. I just showed you it was the top throughout May. So again, here's another example of how certain levels are more important than others. This thing, the important level is 50. It's not 52, it's not 51, it's not 49. Right at 50 is the important level. And that really defies financial, academic common sense and reason as well, but we want to make money, so we don't pay attention to academics. You know the old saying, those who can do, those who can't teach, as I sit here and teach you about this stuff. Well, I like to teach people. I mean, who's better at golf, Tiger Woods or his coach, right? Tiger Woods, obviously, but his coach could still teach him things. So here's the energy sector. We're back in this range now. I watched the 74 level for a long time because it was the top here, and then it was the lows here. But it broke down here, and you can see it's kind of lost importance, I guess, if you would. So next week, I'm probably just going to have this trend line here, or this supply line here, and get rid of this. So we stop focusing on 74. I would look for support around 72 now on the lower side, because that's where it was here, and that's where it was here. Upside, there's a lot of resistance at the 78 level. See here, here, and here. And this is another one of those long-term charts for people that don't believe in charts. So here is the energy sector going back to 2015. And lo and behold, look at the 78 level. It was the exact top here. It was the exact top here. Here. And I know this is hard to see, but right there on July 10th, there's this little one right in here. So again, if these things rally, I'm going to expect to see significant resistance at the 78 level. Now this is materials, which is typically a pretty boring sector. But look at what happened here. It's pretty similar to the financials, right? That's the all-time high. Been in a free fall ever since. Down 1, 2, 3, 4, 5, 6 days in a row. So I don't know. Again, my speculation is some fund somewhere, when the market hit an all-time high, decided that they needed to reweight, and they were underweight materials. because this is pretty erratic trading here. For these things just to like gap up and become really overbought like that. I mean, you can see going back. I mean, there's not a single time that they've been as overbought as they were here. So now we're down to this 58 level, which is the bottom of the range. So we're testing this 58 level, oversold. So it might see a little bit of a bounce, but just keep an eye on the 58 level if you want to trade these things. And last but not least, here's the utility sector. You can see the action in here has been pretty wild as well. These things broke down through their recent range here. Obviously, this is being driven by the interest rate environment. But as we suspected, they found some support around the 52 level, which we were looking for support because it was a top here, and it was the bottom of the route here. All right, so that's it. Thanks for joining in. Just a couple takeaways. Weakness in financials, weakness in materials. Think about how much oil prices have come up over the last year, about 40%. The fact that we're at extreme confidence levels, which could be a bearish indication, and you might say, well, gee, Mark, if everyone's bullish, why is that bearish? Well, here's the thing. If everyone's bullish, everyone's invested all their funds that they're going to invest, and there's no one left to invest anymore, and the market's not going to go higher. And markets can go lower because there's always going to be people selling because they're going to need to raise money for tuitions or buying a house or, weddings or bailing someone out of jail or whatever. So people have to sell for various reasons, but people don't have to buy. So markets can fall under their own weight, and they're not going to rise under their own weight. So basically, when everyone's done buying, there's only one place the market can go, and that's lower. So we seem to be getting to a place like that now. So we'll see what time brings. All right. Once again, thanks for tuning in. I'm Mark Petrino, and I hope to speak with you all next week. Thank you.